Welcome to the Explainer. So you're looking at executing projects in Nepal, specifically International Financial Institution or Government of Nepal pipeline deliveries. If you are, you already know that emerging markets require some serious strategic maneuvering. You really can't just parachute a team of international consultants in and figure out the paperwork later. It doesn't work like that. Nepal has a highly specific, tightly regulated environment, and making a misstep early on, well, that can cost you significant time, margin, and a whole lot of legal headaches. But don't worry, today I'm going to be your strategic whisperer. We are going to completely demystify Nepal's corporate setup, the tax environment, and the compliance landscape. We'll transform what is usually a dense regulatory advisory into a clear, actionable playbook. Let's dive right in.
To make this super digestible, we're going to break the business lifecycle down into 6 distinct phases. 1. Triggering legal presence. 2. Choosing the right corporate structure. 3. Compliance costs and timelines. 4. Navigating taxes and repatriation. 5. Revenue optimization strategies. And 6. Branch closure versus dormancy.
All right, let's start with phase 1, triggering legal presence.
Here is the legal trap you absolutely need to watch out for. When you send international experts into Nepal on a rotational basis, you are actually playing against 2 completely different regulatory clocks. Under the Companies Act, if your team is in country for a cumulative period exceeding just 1 single month, you are legally required to register a formal presence. Simple enough, right? But independent of corporate law, the Income Tax Act dictates that a taxable service permanent establishment is triggered if your personnel are there aggregating more than 90 days within any 12-month period. You have to monitor both of these clocks meticulously to avoid operating illegally or suddenly triggering surprise tax liabilities.
But hey, here is a massive strategic shortcut. If your parent entity manages to secure a direct contract awarded by an international financial institution, like the World Bank or Asian Development Bank, or directly from the government of Nepal, that contract is golden. The agreement itself actually serves as your statutory government approval. This means you get to completely bypass the notorious, lengthy foreign direct investment approval pipelines that regular commercial entities just have to suffer through. You literally take that contract straight to the office of the company registrar.
Moving right along to phase 2, the right corporate structure. You generally have 2 choices here, but honestly, it's really just one. A liaison office acts purely as a communication hub. It's legally barred from generating revenue or invoicing clients. Since you need to actively deliver a project and pay local subcontractors, a liaison office is just completely unviable. You must establish a branch office. A branch office is a direct legal extension of your foreign parent company, fully permitted to generate revenue, sign agreements, and invoice your clients.
Now, this is absolutely crucial, so consider this a major warning. Because a branch office is merely an extension of your headquarters, it doesn't create a protective corporate veil. There is zero ring fencing. Every legal, operational, or financial liability incurred by the Nepal branch extends directly back to your parent entity. You really need to operate with absolute precision here because your global headquarters is technically on the hook for everything.
And speaking of precision, how exactly do you handle local staff without taking on massive liability? Well, it's legally permissible to operate relying entirely on subconsultants rather than putting locals on a formal payroll. But, and this is a big but, you must explicitly execute these agreements as contracts for services, plural, not a contract of service. If you use the wrong legal phrasing, you inadvertently trigger Nepal's Labor Act, which means you suddenly owe mandatory retirement fund contributions and employee protections. Wording is literally everything here.
Okay, let's talk numbers. Phase 3. Compliance costs and timelines. I want you to take a mental snapshot of these statutory financial commitments. Setup and onboarding, getting your permanent account number, value-added tax, and ward office registrations, that's going to run you between $1,500 and $3,500 US. Then you have your ongoing annual compliance. And no, this isn't optional. It involves monthly VAT and withholding tax filings, plus an annual statutory audit by a licensed Nepalese auditor. You should budget $3,000 to $6,000 a year for this. Finally, the closure phase. Exiting the country legally requires a comprehensive tax audit and public notices, costing you roughly $2,500 to $5,000. Make sure you factor these hard costs into your project margins on day 1.
Which brings us to the most critical topic for any international business. Phase 4, navigating taxes and repatriation.
Getting your money out, or profit repatriation, is legally guaranteed in Nepal, but it requires running a strict bureaucratic gauntlet. You can't just wire money home whenever you feel like it. Step 1. You must get a tax clearance certificate from the Inland Revenue Department proving you owe absolutely nothing. Step 2. You take that, along with your audited financials, to the Department of Industry for an official recommendation letter. Step 3. You present that recommendation to the central bank, the Nepal Rastra Bank, for the final clearance to buy foreign currency and wire it to your offshore account. Miss even one step, and your capital is stuck.
Now let's rapid fire through your tax matrix so you know exactly what to expect. First up, the baseline. Any net taxable income attributable to your Nepal branch is going to be hit with a standard corporate income tax rate of 25%.
Next hit. When you successfully navigate that repatriation gauntlet we just talked about, and you distribute those net after-tax profits back to your parent's entity, the moment of remittance triggers a final withholding tax of 5%.
And finally, the cross-border service fee. If your parent entity in the UK, the US, or elsewhere invoices your own Nepal branch for remote technical input or management overhead, the Nepalese government hits that with a pretty hefty 15% non-resident withholding tax.
But remember how I said I'm your strategic whisperer? I want to point out a very clever workaround here. If your corporate structure allows it, route those cross-border management fees through an Indian subsidiary, instead of directly from Europe or the US. Under Article 12 of the India-Nepal Double Taxation Avoidance Agreement, you can legally reduce that 15% cross-border tax down to 10%. That 5% difference on a multi-million-dollar project, yeah, that is massive.
Now that the taxes are clear, let's look at Phase 5, Revenue Structure and Optimization Strategies. The secret sauce here is a dual contracting split invoice architecture. Never sign a single unified contract for the whole project. You need to separate it. The offshore contract component covers all remote advisory, data analysis, and report drafting done back at headquarters. You bill that directly to the international financial institution. That money never even touches Nepal, and it is completely outside Nepalese tax jurisdiction. The onshore contract covers only local site assessments and ground operations. That is billed exclusively through the Nepal branch, and only that portion is subjected to the 25% tax we discussed earlier.
Furthermore, you are absolutely legally permitted to deduct expenses passed down from your head office to the branch. But to survive the inevitable Inland Revenue Department tax audit, you can't just send over an invoice. You need rigorous, documented arm's-length evidence. This means having synchronized timesheets for your international experts, formal intercompany service agreements, and highly detailed cost allocation breakdowns. If you don't have this paperwork locked down, the auditors will disallow the expense and tax you on it anyway.
We've made it to the final stage, Phase 6, Branch Closure versus Dormancy.
6 to 12 months. That is literally how long it takes to execute a voluntary liquidation and formally close a branch office in Nepal. Why so long? Because the Inland Revenue Department executes a final tax audit where they review every single voucher, every monthly VAT return, and every cross-border bank transfer from the entire life of your branch. You cannot repatriate your residual capital until they are 100% satisfied.
Which leads us to a highly counterintuitive piece of strategic advice. If your project pipeline in Nepal is intermittent, say you have a project right now and you might bid on another one in a year or two, entering that expensive 12-month liquidation loop is a terrible idea. The most cost-effective alternative is to simply keep the branch alive in a dormant status. You keep your local accountant retained to submit compliant nil monthly tax returns, showing zero revenue. It keeps the entity perfectly legal and ready to reactivate instantly when that next contract drops.
We've covered the triggers, the traps, the hard costs, and the absolute necessity of structuring your contracts correctly before you even enter Nepal. So I'll leave you with this final strategic question to chew on. When your current contract ends, will you endure an expensive, exhausting closure loop? Or will you play the long game, keep your branch dormant, and be instantly ready for your next major Nepal project? Understanding this playbook is truly the difference between a highly profitable delivery and a complete compliance nightmare. Thanks so much for joining me for this explainer.